Great to be back, John and Carl. Special on a green day in the markets before a holiday weekend.
Yep, we got one. Actually, Dow may go green for the month. We'll see. But I wonder, to the degree that you are beginning to see departments rein in spending, where do you start? Where does a company start?
Well, I think the most impressive thing to date has been the continued outperformance of tech companies, and it really has been all about valuations, the interest rate reaction, the multiple question, et cetera. What we do think will start to happen, though, is the boardroom conversations are going to roll through to spending, which is that just about every boardroom in America, certainly in tech and enterprise, is having the growth versus cash flow discussion. How should we think about tuning these dials for more efficiency? The implications of that are going to be slowdown in hiring and discretionary spending cuts as these companies are looking to trim that margin, the burn rate, to increase the margin profile. We haven't really seen that to date, but I absolutely expect that the earnings updates are going to start to roll through where people are going to do those trade-offs, and you're going to see a few points of growth given up for more than that on the bottom line impact over the coming year. And it's a conscious trade-off given the increase in cost of capital.
Right. Where does IT spend, and really, I guess, advertising as well? Are those one of the last to get cut, one of the first, somewhere in the middle? And I guess in terms of seasonality, I mean, we're still more than 6 months away from year end. I guess next year's budgets are starting to get talked about now?
They are. And what you're seeing is there had been some tech debt. And so a lot of these enterprises, as they were investing in COVID responses and distributed systems, they have infrastructure needs that need to be attended to. And so I think that those will be back burner priorities to be cut, meaning that they will be forward projects to address. However, things like payback on sales and marketing spend that companies used to be able to spend at a 2-year clip to get a 2-year payback when cost of capital was low and valuations were high, that's now come in where companies are looking at 1-year paybacks. And as a result, you're going to see cutbacks in marketing budgets first and foremost. Things like recruiters and recruiting software are going to be slowed down. The FANG stocks basically have hiring freezes in place. A number of companies are starting to roll those through. Layoffs are starting to happen as well. And so you're going to see some flex. And that's why it's not surprising that companies like Workday with core HR tech exposure are seeing some softening. And we expect that to roll through to some other names as well.
Okay, Byron, good morning. It's John. So we've got Zscaler and Autodesk up 8+% so far this morning. So I'm going to ask the question that I asked at the top of the hour, the why not buy now question. I know that you've generally, of course, been bullish on the future of these innovative tech companies, especially when it comes to the cloud and SaaS. But what would have to go wrong, whether it's a longer, deeper recession than some expect that changes the PE calculation, the revenue calculation here? What would have to go wrong for this to be a bad time to buy?
So I think that's a question we all need to be asking right now, because these companies are down to 6 and 8 times revenue right now, 6 times forward, 8 times run rate, which implies at a 40% long-term net income margin that they're really trading at 15 to 20 times PEs on a pro forma basis, which is really a bargain, even excluding long-term things like hypergrowth, TAM markets, technology disruption that we're leading, et cetera. And so these companies that are growing rapidly, you see Zscaler posting 60+% growth rates and approaching 20% free cash flow levels, are some of the best names in all of the industry, nonetheless tech and software. And so at some point, people need to step back and say, we've seen it before. We've seen Adobe, we've seen Viva, we've seen Qualys, we've seen cloud companies run their mature models where they can be at high 30s, low 40s free cash flow. That's absolutely possible with the majority of these companies if they chose to pull back on growth meaningfully. They're just not yet choosing to do that because the investment prospects are way too compelling. And so you're going to get both. You're going to start to see a little moderated growth, but still hyper growth by broader standards and high free cash flow leverage. And so I admit we got out over our skis last year as these multiples were deep into the double digits. We're seeing single digits and low double digits for premium top names. And I'm not calling bottom yet, but we have to be near it because these are bargains. If you look out a couple of years, these companies are going to be worth more.
Byron, I wonder how much does a bottom really matter if you've got a time frame that's more than a couple of years? I mean, but people are scared, understandably. I mean, Snowflake was up near 400. Now it's at 124. Zscaler let me see, it was up also around, let's see, 350-ish, and now it's down 150-ish. But, you know, like you said, if you've got 60, 85% year-over-year growth rates, how long can that continue, though?
Well, I think that's a great question. I'm excited. You've got Frank on the show later. Ask him where they were posting over 100% growth rates. They've given a forward guide down, I think, 66% or so, while generating significant free cash flow. It's a staggeringly good business. They've got dials to turn either way, and they're just playing with those trade-offs. Again, as their cost of capital goes up, they're saying, look, we'll pull in our payback periods a little bit for those trade-offs. But I've got to believe that we're near fundamental value for these businesses, and I believe there's much more there. I believe that they're leading a tech transformation. We're seeing this replatforming in software and in tech, and these are the names that are driving it across the cloud computing industry. And so if you're a trader plus or minus a few months, who knows? We've got massive volatility, macro uncertainty, geopolitical that you're dealing with, and so people are moving money around daily to get these spikes. But if you're willing to look out several quarters or potentially several years, I think names like this you can put in a drawer, and they're going to be worth more in the coming years. The multiples can't come down that much more, and their organic growth rates are going to power them through to stock gains in the years ahead.
That's a good way to put it. There are an awful lot of trees, and we're trying to see the forests through all that volatility, Byron. A good weekend. We'll see you soon.
Thank you. You as well.